Welcome to the deep dive video update. This is a weekly video where I pull out the charts that maybe I used a little bit throughout the week, other charts that I don't use at all, and I put them into this video. There are also some other charts that I only show in this particular video because we have to look deeper to see, are we getting any insight from these charts? It's not really blatant. I don't use them, at least currently, in the daily video updates. So we go through these and try to get a handle on what's happening in the market. Okay, this is being prepared for Monday, August 25th. Before diving into today's video, if you find it helpful, consider a 30-day free trial to the SPX investing program. This trial lets you explore my unique approach to market analysis. Full-length daily and weekly videos are available on a delayed basis after the market closes. For immediate access, become a member by clicking on the link below. The first chart I only use in this video, it is a long-range look at the VIX. The VIX is on here, but over top of that, I put a 50-period exponential moving average. Then I turn the VIX invisible, and all we see is this blue line. And we are still in a lower range. We're below 20. And we've been coming down with the VIX. Now, we started to really come up as stocks were going down back in the spring. But since we bottomed and are coming up, and we're not at all-time highs, but very close to that, we see the VIX rolling over and starting to come down longer term. And that's more positive for the market. We also look at what direction, what is the momentum of the VIX. I use a MACD to measure this, and we're pretty much flatlining right now. We were starting to go back up with the VIX, and then Friday happened, and that was a pretty positive day, and the VIX came down. And so overall, we're still kind of going sideways here. So we're not getting a lot of additional insight from this chart. We also look at the speed of the VIX a little different way using an RSI based on 9 periods. I only really show this chart if we're above 70 or below 30. We're not above either of those right now, so there's no need to show this chart. Since we've been in a range here, it just means that the VIX has been more orderly at this time. And then we look at the VIX and do a correlation with the S&P, still getting quite a low reading here. When I pay attention to this is when we go above the dashed line. We're currently far away from that. We look at the VIX, and then there's a thing called the VVIX, or volatility of the VIX, and do a ratio. And in the context, as we've been going up with the S&P, this ratio has been going down. It's still continuing to go down, and that's positive. We look at the Ulcer Index, another sentiment gauge. It's not really going up. When we see a lot of fear in the market is when the Ulcer Index goes up. We're still below the moving average. And we look at a ratio between the volatility of stocks, the VIX, and the volatility of bonds, the MOVE index. And we were starting to go back up again here. This was causing a little bit of a concern, but now we're drifting lower again with the moving average here. And that tends to be more positive. That just means that both the volatility for stocks and bonds is declining. And the Skew Index, I was showing this chart for a while because we got up into this red area. That means the market is expecting some kind of a big move. Well, we didn't really go up much higher, and then we started to come down, and we're down in this more neutral area right now. And this tries to anticipate that there'll be a big move in the market. And we don't really know if it's an upward move or a downward move. We have to use other charts to get that context. But now I pulled this chart out of the daily videos because we're below the red area. We look at a ratio between large caps and small caps. And you can see we did fall down. Now, small caps had a good day on Friday. They like a lower interest rate environment. And when Powell came out with his speech and hinted at that, at least that's what the market's taking away from it, that really helped small caps. And so we saw this ratio really coming down. Now, we'll have to see. Are we going to develop into some kind of a trend? We've been pretty choppy for most of 2025. And if this continues to go down, that will mean that small caps are outperforming. If we turn and go back up, that means the large caps are outperforming. And we look at a risk on to risk off ratio, really choppy lately. Going up, going down, going up, going down. It did go up in Friday's session because the stock market went up. And typically when we're in a more risk on posture, this ratio tends to go up. But we really haven't been getting a lot of insight. Not like we were seeing coming up out of the April lows. High beta to low beta. Again, usually when this ratio is going up, that's more positive. When this is coming down, that's more negative. Really choppy. We were actually starting to decline here, and that was causing a bit of a concern. But then this really shot up in Friday's session, and now we're back into this range that we've been in. These are just percentages going from the major lows set in 2022, 2023, and then 2025 here, and the percentage gains that we've seen from those lows. And we're also watching the 200-day simple moving average. We're still below this dashed line here that's blue. That's when we get to 10%. And now, there's nothing magical about 10%. It's just when we go above that, that means we're getting pretty far away from the simple moving average. And even from a longer term perspective, the market is looking more vulnerable. We're still below that right now. And we have some anchored weighted moving averages here. I added another one here when we really came down. This was when the employment report came out, and then we quickly got back above these moving averages here. I also put this orange anchored weighted moving average here in case we start to fall. Now we've already been down to this point and we were showing some weakness, and then Friday happened and we came back up out of that. So this would be the first area of support that we might break if we start to see a decline. Then this kind of gold line here, that's the next one. That was the breakout that we saw back in June when there was good news about the trade deals that came out. And that's really when the market started to take off and go higher. And then if we continue to go down from there, there's a lot of other moving averages here that could provide levels of support. And I really haven't been showing this all that much. There are some advanced decline line studies that I show in every video. These kind of come and go. We're not quite back, but we're not that far away either from an all-time high with the cumulative advanced decline line for the S&P based on price. We're lagging just a little bit. You can see we're a little bit higher based on price. We're not quite that high here based on volume. Maybe not a big deal, but we tend to like it when volume is leading price, especially when we're going up. That means there's more volume that's being bought than's being sold, and then price will quite often follow that. So you could take this as a little bit of a negative divergence, but these charts are hardly negative in and of themselves. And the advanced decline ratio based on price and volume were above zero with both. And I have other charts that show this same type of study. So this comes and goes out of the video. And then we look at a longer term 10-day average of the highs and lows for the S&P. We're going back up, but we're not quite up to the green line yet. But this is positive since it has been improving, and that's longer term. Then we look at the cumulative advanced decline line for the NYSE, setting an all-time high. That did break out. Now, in Friday's session, we saw, well, growth did well, but value also did well. And we've been seeing kind of a defensive shift. We're seeing more stocks than just a few participating in this upward move. Now, that could be positive, but if a lot of these stocks that are participating are more value-oriented, that could be the market getting more defensive. And we're kind of right in that whole scenario right now. We could switch back over and have more of a growth stance, and that would really help the indexes go up. Or was Friday more emotionally based and just let everybody do what they want to do? And then in the upcoming week, we might see the market actually decline. That's what I'm going to be watching for in the upcoming week. But in the meantime, we're setting an all-time high here with the NYSE cumulative advanced decline line, as well as the regular NYSE advanced decline line. Also, this is a different NYSE advanced decline line. It's calculated a little bit differently. That is setting an all-time high. So you could say this is positive. This is broader market, but we're not seeing this with the S&P at the same time. So that's a little bit of a negative divergence there. Then we just break it out based on common stock. Not quite back to an all-time high based on price or volume. So this is leading a little bit, and we're going up a little bit more based on price, lagging just a little bit here based on volume. Not a huge deal, but just something to make note of that we're seeing a bit of a negative divergence. Then we look across the broad market and take a 5-period moving average of the highs and lows. We're above zero and starting to go back up. That's positive. And we're not back to an all-time high with large cap growth. They've been lagging. Even earlier in the week, Monday through Thursday, as the market was under a bit of pressure, going sideways, not really showing much conviction, we were seeing this general shift over to a more value type of stance, and that is quite often when the market's getting ready to go down because it's more defensive. Now, that could all get wiped out. We could have some good gains in the upcoming week. We could see this continue to break to the upside, set a new all-time high, and put the concerns that we're seeing right now at ease. Or the market may feed into that a little bit more and we could actually see some declines. Then momentum stocks actually starting to go down a little bit here. We've been going up, at least in Friday's session, but this has been drifting lower as the S&P has been going lower when we do a ratio with the S&P. So they're starting to underperform. We're seeing more value stocks rather than momentum-based stocks. This is trailing off and has been since we got into the month of August. U.S. stocks still underperforming international stocks. We were showing an improvement here, but now we're starting to level off again after we spent the first part of 2025 really declining with this ratio. Mastering the stock market is challenging and can take decades to achieve. Most beginner traders and investors feel overwhelmed and often fail. Stay ahead with the SPX investing program. Members gain access to the full program. Other options include immediate access to videos as they become available. Alternatively, the daily and weekly newsletters may be helpful. Click on the link below to find out what's best for you. Technical alerts. Earlier in the week, a lot of red. Then Friday, we just kind of blew out the gate with a whole lot of positive things because that was a pretty solid up day where a lot of good things happen, but we're still dealing with some areas. We have overhead resistance for the S&P, not only on the daily side, but on the weekly side. We have overhead resistance with the NASDAQ and NASDAQ 100, and we're going to need to get above those and close above those for the market to turn back more positive. But there was some good things that did happen in Friday's session. Then we look at the score now. We have the NASDAQ Composite coming in first place this week at 77.9. Not a real super high score. We would like this to be up into the mid to upper 80s, maybe even the 90s to show that it's really strong, but it's still a respectable score and coming in first place. Then, believe it or not too long ago, we were down in single digits. You go back to July, we were down below 10 with the small caps. Now we're up to 77.2. This really saw a big improvement. Now, is this another false start? We've seen many of those over the last few years. Small caps have a good couple of days. It looked like they're breaking out to the upside, gets everybody excited, and then things shift and they start giving back those gains. Is that what's going to happen this time, or is it more for real? They like a lower interest rate environment because it makes their balance sheets look better. If they have to borrow money, it doesn't cost as much, and so they end up making more profits. And so small caps saw a lot of enthusiasm in Friday's session. Then we have the QQQs, which is growth. Usually this is number one on our list. No, it's not now. It's still coming in at 67.9, so we're above that 50 level, but not really showing much improvement. Then we have the S&P, which is a mix between growth and value. When the growth stocks are really performing well, that's what drives the S&P up. And we're still doing okay, but we're drifting down a little bit. We're just really close to all-time highs, and to see our technical score actually going down this is usually maybe number 2, maybe number 3 in our list, and it's further down this week. Then we have the Dow, set an all-time high on Friday, but it's just barely above 50 at 54.3. Now it is improving, but it's really had been lagging for most of August and actually starting to drop down in the end of July. Then in last place now, under 50, are the mid caps at 49.9. Even though they are improving, before Friday's session, we were down in the 20s, so this was quite an improvement here. Okay, now we have a short-term rainbow, still above the rainbow. The lines are going up. Short-term trend is still positive. Intermediate term, above the rainbow, all the lines are going up, so intermediate term trend is positive. We're well above the 50-period moving averages and the 100-period moving averages. And we did get above this R1 pivot point here with the S&P. Can we stay above that? Because this is kind of where we started a flat line right here. We're going to need to break above this. The resistance that I'm talking about is at 64.68. And we closed at 64.67. So we're just 1 point underneath that. I know is it that big of a deal? Well, watch the daily videos because the market knows it's there. The algorithms that trade using computers, they know it's there. And for 2 weeks, we've been battling that level, and we have not been able to get above it on a closing basis. We get above it on an intraday basis, but then by the time we close, we're down below that level. Then looking at the Connors RSI, it is positive above the midpoint, but not extreme right now. Then these are just rough estimates at different percentages. If we do get to the point where we top out and start to come down, I'm going to be watching this on a percentage basis because that will determine whether this is just a pullback or we're going to a correction. Is it going to actually turn into a bear market? And those are defined by the percentages from highs. And so really not much to see as long as we're continuing to go up here with this particular chart. It's mainly we'll use it more if we start to decline. And now the S&P 100 has been underperforming the S&P 500. That's not what we've been seeing for most of the last few years. We've just been seeing this recently. And when the S&P is stronger, the S&P 100 outperforms. Now it was up, but not up as much, and it really underperformed in Friday's session. We're going to be seeing if that continues, or was that just like a one-day wonder, and then we're going to go back and see the S&P 100 begin to outperform. Mass index not generating a signal right now on the daily chart. We're below the moving average with standard deviation. This measures how fast we're moving, and we're not moving all that quickly here over the last 10 periods. And we are coming up here, but I only show the CMB composite when we're above the black line on top or below the black line on the bottom, and we're not extreme right now. We're above the midpoint and going up after we had been declining here with the percent B indicator. This measures whether we're above or below the upper or lower Bollinger Band. We're not there right now, but we are positive since we're above the midpoint. Not enough of an upward move to generate any new point and figure signals here, but the last signals that were generated were X's, and that's buying. O's mean selling, and we're still working off of a triple top breakout that was generated on August 13th. And so this chart is still positive, but this only looks at price. It doesn't take time into account. Long-term rainbow still looking really good with our long-term trend, still above this red line. Now the red line is still going down, but this is a very slow oscillator called a special K. But for the first time since last spring, we're actually crossing back above and turning positive. I don't show it here, but the weekly chart is also positive, and that's longer term positive for the market. And then this is an apples to oranges comparison where we were really starting to underperform when we compared the S&P to the NYSE advanced decline line, but they both really kicked up and they're matching up better with each other right now. Then we look at the ratio between the weighted and equal weighted version. When this is really coming down like it is, that means the S&P is underperforming. Now, the equal weight did set a new all-time high on Friday, but that was not set by the S&P 500. That's positive since broader stocks are participating in that, but you could also put that in as a negative divergence because the broader S&P 500 is not confirming that right now. Now, if we see this continue to go down, that might mean that the market is getting more under pressure and starting to decline. We look at a weekly chart of the S&P on the top, a weekly chart of the German DAX, and you see the correlation is still pretty strong between the two of them. Support and resistance, I was showing this chart as we were coming down earlier in the week, and this tends to act as a support level, one more above it and coming down. This is just a 20-period simple moving average of the open, high, low, and close. And we were right in the middle of this little mini rainbow after Thursday, and then we shot up out of it after Friday. And I didn't show this in the latest daily video because we're above the rainbow again. And we're also above the cloud here when we look at this Ichimoku cloud chart, and we're looking positive. This green line is short term. The blue line is more intermediate term. The red line is long term, and we have the green above the blue and blue above the red. That's all positive. We're above the cloud, and the cloud is still green. So that's still looking quite positive there. Then we look at the VIX-in, which is the VIX for the NASDAQ 100. It's also been declining overall, both with the bar chart and the line chart. Then we look at the S&P on top and then a growth to value ratio here, pretty much back to neutral because we've been seeing value holding up a little bit better, growth underperforming. And so that's bringing the correlation between the two down just a little bit. Then we look at the Dow, which did set an all-time high. That's the black line here. And then the transports, which are lagging. So according to Dow theory, this is a non-confirmation. And the perma bears are going to be all over this. It's like, yeah, we set a new all-time high with the Dow, but we didn't with the transports. Ooh, doom and gloom. Everything's falling apart. And that might happen. But I would use other points of evidence than just that. But usually you want to see these confirming each other. And quite often, during more positive times here, we'll see the red line actually outperforming the black line. Even though they are on different scales, we can kind of match them up. Then we look at regional banks and compare it with the financial sector. Saw a big improvement on Friday. We've been concerned about the financial sector. It's still underperforming, and it has been since going back to last spring. And we're also keeping an eye on these smaller banks, regional banks. And we did come up out above these moving averages here, but we have quite a ways to go to get this back to a golden cross with the ratio. And you can see the bank ETFs just kind of chopping along. We fell, then we came back up. We were really range bound, and it had a good day on Friday, up 4.66%. Is this the beginning of something, a one-day wonder, or an overreaction that we'll see some selling coming in? That's what we're trying to ask right now. Still going sideways when we look at energy to the 10-year bond ratio, and still going down when we look at the gold to S&P ratio. And gold is just continuing to go sideways where the S&P is going up. And when that happens, that's when this ratio goes down. And emerging markets to developed markets pretty much going sideways since about halfway through July. Not really getting any insight here. Then we look at the 10-year yield in the U.S. We subtract the German 10-year yield, and then we plot that against the U.S. dollar index, starting to see a stronger correlation between the top chart and the middle chart. As weird as it is, there is a pretty strong correlation most of the time between these two charts. German DAX near all-time highs, but not quite there, and kind of chopping around when we compare it to the S&P 500, U.S. stocks. Retail in an uptrend, looking okay, still has a ways to go. It's breaking out above these previous highs, but it still needs to go up further to get back to the all-time highs. And we're starting to flatten out here when we look at the ratio between retail and the S&P. So it had been declining. Now it seems to be flattening out, and actually you could make a case that this is starting to go back up. So we'll keep an eye on that. And then the staples to tech ratio, it had merely been coming down. Then we started to go back up. That's the market getting more defensive. That means staples are outperforming tech, but then this came back down. Overall, we're still declining here, and we're going to watch this chart every day and see how it plays out. Another one is staples to the S&P 500, really choppy lately, not getting an awful lot of conviction now. Long-term rate of change charts did decline a little bit here with this longer-term chart based on 250 periods. Also declining a little bit here with that same chart, but going back to 1980. With each video and course, members learn to implement the consensus approach, a unique analytical method. Unlike relying on a few indicators that eventually fail, this approach overcomes analysis paralysis by using the weight of the evidence to draw conclusions. Developed over decades across all market conditions, explore the SPX investing program and start with a 30-day free trial. And then we look at the relationship between different types of bonds, different maturities mainly, and we see, is the bond market concerned about inflation and interest rates? Not according to this chart. This ratio continues to go down. This means that cash is underperforming 3 to 7 year bonds. When this ratio is going up, that means there's uncertainty about inflation and interest rates, and we're continuing to go down with this ratio. Now, we did come up a little bit here with TIPS, which are Treasury inflation protected securities. That's what people get into when they're worried about inflation and interest rates. Well, this ratio did go up a little bit here. We'll see if this tends to equalize or if it's going to continue to go up. And then we're coming back up a little bit with TIPS to the 7 to 10 year measurement here, but really going sideways. And then we look at the long-term bond, which is in blue, and the S&P 500, which is in red. And we're drifting down a little bit here with the longer-term correlation. We're pretty much back up to neutral with the shorter-term correlation. And we do that same thing. We look at the Qs, which are in black, and the long-term bond, which is in red, going sideways a lot here. And we're coming down and just coming back into neutral territory with the longer-term correlation. Is this suggesting a shift in the market? And we want to keep an eye on the 10-year to 3-month yield curve. We're still okay. We're positive here. We haven't gone inverted for about a week now, but we're really choppy right around here. We'd like to see this go back up. If this goes inverted and then goes back to being regular, that's usually when we start the countdown to see if we're going to go into a recession. Now, most people don't use this chart. They use the 10-year to 2-year yield curve, and that one's looking okay. This is the one that's been acting kind of crazy lately. And we're seeing a gradual decline still with the 2-year treasury yield. It just means shorter term interest rates are going down. And then here's another apples to oranges comparison. Eurozone stocks to American bonds. Eurozone stocks are outperforming, really close to an all-time high with this ratio. And then we look at the percent of stocks in the S&P above their 200-day simple moving average. We're above 50 and going up. That's positive. Those stocks above their 50-day moving average in the S&P, above 50 and going up. Mid caps also improving. Small caps improving as well. Then a Staples to S&P ratio. Actually, it's a S&P to Staples ratio. This is holding up fairly well. It was starting to come down. We were coming into the rainbow, but then Friday happened and we went back up with this ratio. So this is still holding up for the time being. Thank you. I hope you found this helpful. Have a really good weekend, and I will talk to you in the next video.